Good day, everyone. My name is Rebecca Lilly with the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Reconciling Hotelling's Mind, Resources and Accounting. We are grateful to our speaker, Robert Cairns, for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services you can find at our website, www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speaker. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our speaker, please click the Q&A button at the bottom of the Zoom window and type your question. We've allocated time at the end of the webinar to read and answer them. And now I would like to introduce you to our speaker, Dr. Robert Cairns of McGill University. He works mainly in non-renewable resource economics, the economic theory of sustainability, and the economics of accounting for resources and for sunk costs. Robert, over to you.
Thanks, Rebecca. Welcome, everyone. I'm glad to be here. I hope you enjoyed the presentation. What I'm going to be doing is something of a run-through. Well, the paper does a run-through of some of the main theoretical models of non-renewable resources. And John Hartwick and I, the 2 co-authors, interpret and reinterpret these models in terms of accounting. And we find that some of the accounting that's being done in work on green accounting doesn't square with what we think should be being done in accounting, and doesn't seem to be squaring with regular accounting, which is, of course, the source of the data that we use to try to understand things. So you'll find that there's something for theorists, I guess, in this, as well as practitioners, or I hope you do anyway. So let me begin by sharing my screen with you. And, well, I won't start with my conclusion. The title is Reconciling Hotelling's Mind, Resources, which is, there's a mistake, 1931 it should read, his paper in the Journal of Political Economy, which is very famous, and his paper on accounting in the Journal of the American Statistical Association, which is less famous, but was written in 1925. So please treat that 1939 as my mistake. It should be 1931. And then the accounting, I hope, is right, 1925. So he did a paper on accounting in which he outlined how he thought that accounting should proceed. And I'm going to refer to both of these papers as I go along. So here's my question. I want to find the role of capital gains in appropriate accounting. Now, what happens in green accounting? This is the kind of accounting that's outside of standard financial corporate accounting, but is occurring for the environment, is that theorists have stated that capital gains should not appear in income. The reason given is that capital gains arise because of the pure passage of time. That means that there's no human input to it. In particular, they don't arise because of human decisions. Economics is the study of decisions. So I presume that the reason that these things that are due purely to the passage of time, why they are left out, is because there's no decision involved. Now, though there's no decision, they do affect decisions. And so I go back over the theory and I come to the conclusion that capital gains should be included, as they are in standard accounting. And if you have any capital gains in your personal account, as you know, they are in tax accounting. So there are two matters here. First of all, there are some technical questions that have to do with the models in question, which are highly simplified. And secondly, there are the implications that we find for accounting. Why are these important? They're important because accounting is important for investment decisions. Investors use accounting data for making decisions. They're important for the evaluation of securities. As I've mentioned, they're important for determining taxation of capital gains accruing to individuals and companies. And they're important for clarity of theoretical thought in non-renewable resource economics, and more generally in economics proper. Excuse me. So let me move on to what I consider to be the fundamental accounting points that I'm going to raise and address in this talk. First of all, an aim of corporate accounting and financial accounting, and implicitly green accounting, is to recover costs of capital which are incurred at specific points of time from revenues that are occurring through future times. Because these capital items are being used, and they're being used to generate these revenues, the firm, of course, has to cover these costs as well as the current costs that are going into their inputs. An important feature of that is that depreciation, undiscounted, so that is just pure numbers of dollars or euros or whatever, the depreciation over the total time period at which it's being taken sums to the original cost. This I call the adding up property of depreciation. So you just go through and add these numbers up over time, because the numbers are the decrease in the value of the capital over a time period. A second fundamental point of accounting is that income is equal to product. This is true in a net sense. It's true in a gross sense. It's true in a micro sense and a macro sense. Income has to be equal to product. This is a fundamental accounting identity. And the third point is that sectoral and macro values, so the values in the national accounts, are sums of micro values. That is to say, are sums of values that apply to individual households or to individual firms or to individual products. And these are summed, taking simple sums, to get our totals, which are reported as variously gross domestic or national product, net domestic or national product, and so on. There are incomes and products that arise in firms, and if you want to stretch things, in households. So what I'm going to do, I take 6 canonical optimization models from the hoteling work on hoteling since 1931. This work moved along in a pedestrian fashion until the energy crisis in the 1970s, then exploded because hoteling was all of a sudden somebody who was telling people something about how resource markets worked. His paper was about the pricing of oil in his home market in California. A characteristic, a general characteristic of hoteling models is that they model only the resource. So the resource is considered to be natural capital, and we're modeling capital, but there's no traditional investment here in these models. So we don't have to have drilling. We don't have to have shafts, mine shafts or oil wells. We don't have to have surface buildings and equipment. We don't have to have railway spurs or anything. There's only the resource, and the resource is modeled as if it's a box of chocolates, and you just eat as many chocolates as you want at a sitting until the box is finished. Now, what I have is 5 sectoral models of a world stock or a market stock for the relevant market. And then there's one model of a firm, which really is the oldest model of the bunch. They're simple models. The reserve is known and homogeneous, and it's just given as if you've opened a box of chocolates and are deciding how many to eat. John and I reinterpret these models using the insights from accounting that I mentioned earlier, the fundamental points. So let's think about an optimization model in which we're maximizing the net present value of a reserve I call S, capital S, and this is going to be the reserve of the entire sector. We get the maximum net present value, and it gives us a mathematical expression for net present value. Now, if this net present value does not depend on time t, it's called autonomous. For an autonomous model, there is no capital gain. If the net present value does explicitly depend on time, and that's because of the dependence on time of all the factors that go into the mathematical analysis, it's called surprise non-autonomous. If it's non-autonomous, there's something of a drift through time. That is to say, the influence of time causes the value to drift in addition to changes because of decisions made by humans. So we get a capital gain, something to do with the pure passage of time. What we're addressing here is whether it should be included in income. Now, Hotelling's rule for one of these simple autonomous, simple natural resources, autonomous or non-autonomous, is that the price will rise at the rate of interest, or if we put some embellishments, there will be some adjustments, but in essence, the interest rate will be an important feature. Since it's rising at the rate of interest through time, the question I'm asking here today, and that John and I ask in the paper, is whether this drift should be included in income. These are my basic findings. First of all, interest on value, that's net present value, equals the sum of output, input, and the capital gain. So I've got for aficionados of the mathematics, I've got that in a tiny fonts here as RTVT, interest on value at time t, on the net present value, is equal to PTQT, the value of output, plus lambda t IT, the net investment value, quantity IT of investment times its price lambda t that's determined in the model, plus GT, the capital gain. Now, in this, we interpret interest on net present value, the left-hand side of this tiny equation, if you're looking at the equation, as income. This has to be true because any kind of income that's accruing over time can be capitalized. It can be, the present value can be taken. And then you can take that present value and allocate it over time as what's known as a user cost. And the user cost, broadly speaking, is interest on value plus the depreciation on value plus the capital gain. But the capital gain is all rolled into the present value. So it's appearing, but it's subtle, let's say. So since interest on net present value, the left-hand side is income, we interpret the output plus the investment plus the gain, that is the right-hand side, as the product because of the equality of income and product. And that product includes the capital gain. In fact, GT, if you are interested in the mathematics, is the partial derivative of the value function V of S and T, which I've written VT earlier, with respect to T. So it's the pure passage of time. Now, in green accounting, depreciation of the resource through time is usually considered to be the hoteling rent. So that's lambda T, the equilibrium value of rent per unit, times QT, the quantity of output. If you do that, though, it doesn't add up if there is a capital gain. That is to say, if the model is non-autonomous and there is a capital gain, then lambda T QT does not add up over time to the value at time zero. And this is the property of depreciation, the adding up property, that I say is essential. If we include the capital gain, then it does add up. Depreciation with the capital gain thrown in, so decreased slightly, adds up to the original value, as it must in accounting. And so John and I reason that depreciation ought to reflect this fact that we have to put the capital gain in, and it reduces depreciation because it's a form of income. And we're going to deal with these points using two examples. So one is the durability of the resource above ground. So we're thinking of taking something out, not oil and gas necessarily, that we burn up immediately, but we're interested in energy resources. So let's think of extracting uranium, which is extracted and stockpiled and used over time in reactors. So it's not burned right up almost immediately. The second one is of a single mine. So we're getting away from the sector here. This is the oldest of the models. And it's a mine with a U-shaped average cost. So that's the representation of a cost function, or in economic parlance, of a technology that you may have seen in your first microeconomics course. And we find that both have the usual accounting with capital gains if they're non-autonomous, and no capital gains if they are autonomous. So our idea that capital gains should go in are borne out in these two examples. And in addition, they're borne out in the other four examples as well, but I don't have time to go through these four examples. I'll just focus on the two. So moving on to the durable resource. We're taking uranium. We're going to assume there's only one form of uranium in the sector. We know it decays exponentially in the reactor. It has a uniform rate of decay that's called a half-life. Now, the uniform rate of decay means that there is an easy summation over all the mines in the sector to get a sectoral total. So instead of just dealing with particular mines, we can think, because of this uniform half-life, we can think of the sector as being, as comprising an all-encompassing stock, and the tendency in grain accounting is to aggregate into this all-encompassing stock and then to depreciate it and to calculate the income from the stock in that way. And the finding is that all of the rent, all of the value produced by the resource, as I want you to recall, all of that is considered depreciation, and none of that is considered income, that is interest on the stock, on the value. This can be done even if the mines are different, such as having different scales, if we assume constant returns to scale, which is frequently done. So we get income and depreciation by sector. And John and I take exception to this and make a slight difference in the technology. We introduce reactors explicitly. So instead, this is a great simplification, but it helps us to understand. We're going to assume that reactors are vertically integrated with reserves, so we don't have much transportation of uranium from the reserves to the reactors. The reactors are installed, and a sunk cost is incurred at the installation, and installation is done when the reserve is developed for production. And we could also say there has to be a development cost up front to develop the reserve, but we don't have that in the paper. Going back to Hotelling's 1925 paper, when we do this, the depreciation and income are specific to each combination of reserve plus reactor, because these reserves are being developed, perhaps some at the same time, but more likely over time, and there's a timing question of when to develop the reserves as well. Furthermore, when we calculate the depreciation and income schedules using the present value of each reactor and reserve and mine, if we have two or more assets, then these schedules are not unique, even though the aggregate schedule is unique. So this is something that is kind of striking, but all that matters, since the cash flows are produced by selling the product from the reactor, which has to do with the reserve and the reactor, we have a unique present value of the combination. But when we try to allocate it over time, we can satisfy all the needed conditions for depreciation and income with different allocations over time to the two, as long as the allocations add up. That means that if there is a profit at one of the mines, the allocation is not unique, because we model the profit as arising because of some reason. We discount the profit into a present value, and we can depreciate and get income from it as well as the other assets. So the upshot is we can get the same decisions, the same net present value. Everything is the same at this reserve reactor, but we can get different flows of income over time so long as the flows, the present value of the flows, that's the only condition, adds up to the present value of the discounted profit. This leads us to conclude that we're going to miss something if we aggregate everything into a simple stock and differentiate and use the sectoral values in our accounting. We'll get some aggregation biases, loss of information in our national accounts, unless we treat the assets, the reserve reactor combinations separately and sum up the micro values to the sectoral values, rather than trying to get sectoral values out of the mathematics and trying to deal with them individually or as a group. So that's a problem with durable resources, and it's a problem with things that occur over time as well. So let me turn now to another kind of resource. This is a mine with a U-shaped average cost. So in each time period, the mine faces a U-shaped average cost. That is to say, it has a negative slope down to a minimum point of average cost, and then an increasing slope. So the marginal cost curve for points beyond the minimum point of the average cost curve slopes upward as well, and is greater than the average cost and pulls away from it as output is increased. This type of mine was studied by Louis Gray in the 1914 Quarterly Journal of Economics, and it was the first modern treatment of non-renewable resources in economics. And it was, as I say, a single mine, the U-shaped cost, and Gray did not bother to think about aggregating up to the sector and getting total quantity, and hence getting a demand curve and so deriving a price. The model was improved by Anthony Scott in a book published in 1967, edited by Mason Gaffney, called Extractive Resources and Taxation. In any case, we had the same thing as in a hoteling model: homogeneous reserve, no capital. So we didn't have the reactor that we had with the durable resource and producing energy from uranium. We didn't have the development cost either. The mine was just presented to us at time zero with no development needed. And in the optimization, the rent, which is considered to be the price net of marginal costs, rises at the rate of interest. That occurs because Gray assumed a constant price. This was a price taker, and the mine would reduce its output, falling down the marginal cost curve, and hence opening a gap between price and marginal cost that rose. And that would continue until output reached the level of minimum average cost. And at that point in equilibrium, we would have exhausted the resource and the mine would close. Now, this rising marginal cost was interpreted as providing a Ricardian differential rent, price minus marginal cost, being the rent that David Ricardo had found for land in 1817. Now, something to remember is that Ricardo went on and tried to talk about the rent of mines, but he got all balled up in his ideas, and he really couldn't explain the rent of mines. Here's something that Louis Gray was trying to do for an individual mine. Our interpretation is that the rent is not Ricardian. Ricardo spoke of differentiated resources. So when he was talking about land, land was of different qualities, and the best quality would be used first. And as demand increases, recourse would be had to lower quality land, raising the cost of production and providing a rent to the better sources, and that rent would increase as demand increased. Here, Gray explicitly modeled the resources being homogeneous. It was not differentiated. So this is not a Ricardian rent. The source of rent is the technology. It's the U-shaped average cost, which in the relevant range beyond the midpoint of the average cost curve has decreasing returns to scale. So what we have here then is two capital inputs, the resource, which is talked about in non-renewable resource economics, plus the technology. And the level of technology in the study of green accounting and in the study of sustainability and so on, technology is considered one of society's assets. This is a particular technology that has particular properties, that is to say, decreasing returns in the relevant range. Both the resource and the technology are essential to producing the output of the mine. In fact, we can't separate their contributions even at the margin. So the marginal rent, called lambda, or the total rent, lambda times Q, is a marginal rent to increasing using both resource and the technology at once. We get a net cash flow. The net cash flow is a joint product of the two capital stocks, one a tangible capital stock, the resource, one an intangible capital stock, the technology. But not only is it intangible, it doesn't have any units. We don't have units of this technology. It's just a body of knowledge that we apply at a given mine. And so the technology has no units and it has no price. I'm assuming that the firm owns the technology. It's a non-marketed capital input then that's just held by the firm. We can imagine in this case a license fee. We pay a fee to Microsoft to use Office. Microsoft charges us Office, but the technology of Microsoft is undifferentiated. It's just that we can be charged for each unit or for the number of units in a corporation or university. And Microsoft makes its profit that way. We don't do it that way in this model, though. So we've got to stick with the terms of the model, and it's modeled as freely available. So we should account for both, but we can't account for the technology because we have to have a price in order to do accounting. And the technology has no price. Nobody is transacting the capital. So that is something that we have to bear in mind. There are assets out there that we know about, we understand, but we can't account for. So this brings us to the idea of capital gains. What are the capital gains in these two models? Well, we've been considering drift to be a movement of the value function through time, just because of the passage of time. Mathematically, it's the partial derivative with respect to time. Now, traditionally, the capital gains are a different thing, different from some partial derivative. They're the sum of the products of the changes in prices and not quantities, in changes of prices times quantities. So here's, sorry about these mistakes, that's the second one. Prices times the quantities. So in mathematical terms, they're the sum of the change of price of the asset over the time period times the quantity of the asset, delta pi si. And we have, in general, several assets which are indexed by I. Now, they're not necessarily the same. So what are they? What's the difference? Well, I want to look at the difference. So I think that what should be done, and John and I do it in the paper, is that we define yi, just some variable, as a residual, which is the difference between the net present value, V, and the sum of the values of the capital stocks. So yi is equal to Vt, the value function, net present value at time t, minus the sum of pi si at time t. Yt here is the value of non-marketed capital. It's the difference between net present value and the value of the priced capital stocks, however many of them there are. So to proceed with the mathematical analysis, John and I take the sigma pi si over to the left-hand side and define Vt as the sum of Yt and the sum of the products of prices and the quantities as in the usual way. We've got y in here, so it has to be a new variable, though it becomes y of s y t rather than y v of st. And the drift works out as we go through the math to be the sum of the changes in prices times the capital stocks. So delta V is the sum of the traditional capital gains. But what happened to Y? Well, theoretically, the interest is still R times V. Here's a mistake again. Interest on value is still R times V, and that's equal to output plus input plus the gain plus the change in the residual, which in a sense is a gain on these non-priced inputs, which are having a capital gain or loss. So we can't account for what we don't observe, and we don't observe Y at all, so we can't observe delta Y. The change in the residual is unobservable, unmeasurable, because the residual is unmeasurable, unobservable. It's just an amalgam of the joint products of all of these other non-marketed capital inputs. And if you ask me what they are, well, they are, I had a source of profit in the durable resource. And I'll bet nobody blanched an eye that where did the profit come from? It was a competitive model, but so it's not monopoly pricing, but it could be the quality of management. It could be the reputation of the firm. It could be special processes. It could be special quality of the reserve. It could be lots of things that are not priced. So we can't observe these factors Y, but they're all going into the profit of the firm, and we can measure the profit as a present value, but they are all producing it in a joint fashion, so we can't separate among them. And we do know the original cost of the priced capital, and we can depreciate it according to depreciation formulas. We could, though, just take the residual, the present value of the residual, and depreciate it in some way that's consistent with the adding up property and with income equals product and so on, and get some value of the depreciation of that. It's an abstract depreciation on an abstract asset, and return to the asset, an abstract return to an abstract asset. So we have to think something outside the box of accounting here, but in a special way that really is consistent with accounting, because what we have to do is depreciate the stocks and then consider the remainder of the cash flow minus the depreciation to be income from the reserve and reactor, or income from our enterprise, which we do in standard counting in broad measure. So how do we do it? Well, we have to do it the way accountants do, but that means that we define income and product as net of the change in the residual. So this delta V is being carried through and shouldn't be. RV is equal to P plus I plus G delta T over the time period, 1 year, delta T is 1 year, or it's 1 quarter, or whatever the accounting is being done, plus delta Y over the quarter or year. What we do is simply take delta Y over to the other side, and we get P plus I plus G delta T, output plus investment, net investment plus gain. That is accounted as income. That is accounted as product, and RV minus delta Y is accounted as income. That is to say, any accounting system is incomplete. Ideally, we wouldn't have to make this redefinition, but we have to take away from both sides those things that we can't measure, those things that are not priced, those things that can't be accounted. So this subtraction preserves, theoretically, the equality of observed income and product. We don't notice that because reported income is not recorded as interest on the present value of our assets. It's reported as observed wages, rents, bond interest, and so on. So we get a different measure. When we add things up in the national accounts, they don't completely square. So we divide the difference by 2 and assign it to each side. That is not the residual delta Y, that's just an accounting balancing. And what we have then is adding up holds for depreciation. So theoretically, we perceive that this is what is going on. The big equation here, RV minus delta Y equals P plus I plus PQ plus I plus G times delta T. That is what is implicitly going on in the accounting, which is done in different ways. And it adds up because of the circular flow that you've probably heard about in your first macro class. The circular flow applies not just to the macro economy, though, it applies to microeconomy as well. It applies to individual enterprises and so on. So adding up holds for depreciation. And we get all of these 3 fundamental accounting principles being satisfied in the theoretical way, and accounting is developed through the ages so that what they do satisfies these points because that's what they want it to do. So here's my conclusion. The hoteling model is abstract. There are a lot of these models that don't take into account what goes on in the mineral industry. It's in fact too oversimplified for practical implications. And that has been a mistake for some of my colleagues in non-renewable resource economics and studying various non-renewable resources over the past 92 years. So we have to interpret Hotelling's model gingerly. We have to leave out variables. So something is happening that we're not modeling and it's drifting along. So non-autonomy is common. We should not be neglecting these capital gains because they're affecting what's happening. We aggregate in finding the sectoral values and doing the theoretical work and empirical work on the sectoral values. Information can be lost through aggregation. We know that. There are aggregation biases. So we recommend that accounting be done at the level of decisions being made to the extent possible, and then that the sectoral values just be the simple sums of the enterprise values. And that makes the mathematics more difficult, granted, but that's how the world works. And it's also important, I've considered non-optimal models here. If the world were optimal and if the world were foreseeable, we wouldn't need accounting. We have accounting because we have to check things for non-optimal firms under uncertainty, and it works out that we can apply our findings to non-optimal firms. That is to say, we just have to define our value function and differentiate it, and we don't have to assume that the first order conditions hold. That is to say, we don't have to say that optimality conditions hold, and we simply apply the findings as we do in accounting, because nothing is optimal out there in reality. So that's what John and I have found by reinterpreting the various hoteling models. I'm sorry I couldn't get through the other four, but as you can see, I've taken up 3/4 of an hour of your time already, and I would have taken up even more. But if you're not deterred by the mathematics, our paper is in the Energy Journal, and you can find it and read it yourselves. So thank you for your attention. I'd be happy to take any questions you may have now. So can we have the questions come in? I guess they come through the chat line in printing. I think a few questions that might arise is early on, I mentioned that hoteling models do not have traditional investment. How is it important, and how does it relate to non-renewable resource models? Well, traditional investment is just the investment that's priced. So it consists of drilling and constructing a shaft. It consists of the pumps at the surface in an oil field, and the construction. It consists of the mine buildings and the machinery and the concentrator and so on at a mine, and the railway spurs and the other things we have to take into account, and we have to deal with that. Now, by dealing with that, we find that there are important issues that are not taken into account in standard resource economics, based on Hotelling's rule. A thread in resource economics in the past 20 or so years, or even 30 years, has been the so-called green paradox. According to the green paradox, using Hotelling models, with the rent rising at the rate of interest, if the tax rises fast enough, that is to say, faster than the rate of interest, we could get what's known as a tilt back toward the present, so that more oil and gas is produced at the present in equilibrium by the sectoral incentives, and we get greater additions to global warming in the present, which is a bad thing. We go to tax the emissions of carbon dioxide then, and we find that we get more emissions. Well, that is an artifact of the Hotelling model. The Hotelling model just gives us that there is going to be such a tilt, but what actually happens is that the resource producing firms, be they energy firms or mining firms, have to look at the entire pattern of production over the entire life of their investments at the time they make their sunk investments. So what we find, and this is found by Jim Smith and I in the economics of energy and environmental policy, that if you have to invest up front and recover that investment, there's a tendency to reduce the investment, and that as a result, we have an offsetting tendency to the Hotelling tendency that seems to be more important in terms of reducing total investment in the sector, and that the tilt of production is not produced by the Hotelling type tilt, but the tilt of production in oil and gas fields is because of natural decline, which we can model as exponential or as occurring according to different probability models or different depreciation, deterioration models or decay models that are more complicated. So what's going to happen is that there will be a level of investment. It'll probably be lower, and then the natural decline will come in at the rate of natural decline. And we don't get anything like the green paradox. And that's simply introducing a model that's based on a better model of oil and gas production by Morris Edelman in the 1990 Review of Economics and Statistics that shows that and does not assume that you can just produce oil as if you're sucking water using a straw or something like that. The other one is the idea that fossil fuel assets will be stranded by policy that restricts the use of fossil fuels, either by a tax or by a limit on production or something. So what will happen is that fossil fuel firms will overinvest because the firms will not take into account the fact that they're going to be taxed and that this taxation is coming and that for some reason they're myopic. And this has been a policy raised by central bankers, and they actually believed this policy. This will not occur, of course, because the investors, the oil producing firms, will be looking forward at what they're going to be able to produce. And they'll be thinking about what their expected pattern of regulation on the emissions of carbon dioxide and controls on production. And they will take that into account. And they'll know that if regulations are introduced, their cash flows will be reduced. And that will affect their investment decision. They'll take that into account. And the investment decision will also take into account the natural decline, so that the bulk of production will be had early on, while the regulations are not in force. And if regulations do come in at an unexpectedly early time, it'll be at a time when the resource has been depleted very substantially, rather than having been exploited at an equal value over time. So the idea is based on the notion that bureaucrats sitting in their offices are more able to understand an industry than the people involved in the industry, and who have an incentive to be correct when they make their decisions, because they're the ones that bear the consequences of the decisions. So they're going to take the decisions into account very well. And this is one reason that I'm cautious about having central bankers come into the market and add their voices to government policy in making policy with respect to global warming. Policy with respect to climate change is important, but because it's important, we ought to be thinking about how to do it right and how to do it in a way that takes into account the technology. So for the best model, look to Edelman's model at the 1990 Review of Economics and Statistics. You can also look at the Festschrift for Edelman in the 2015, Energy Journal, where several papers addressed how petroleum is actually produced. Are there any messages coming in?
There are not.
Okay, so maybe I should hand it back over to you, Rebecca.
Well, IAEE would like to thank you very much for an outstanding webinar. This webinar will be available on IAEE's website for future download. If you're not a member of the association, we encourage you to join by visiting iaee.org. We thank you for attending, and I officially close this webinar.